Good morning, everyone. My name is Sarah Ibrahim, and today we will be talking about our equity research report, and it's research done from the CFA Institute. And in the next 10 minutes, I'll be talking about our financial analysis, valuation, the investments, thesis, the risk mitigations, the risk and their mitigation for it. So we will get started. Investment thesis. Why buy Carter's? So Carter is significantly undervalued with their current price, with their current stock price as of right now. We see there is an upside potential of 84.28%. We used our target price. We got this by using our valuations methods. We see there's a very strong presence in the U.S. market share with a 15.6%. They have a very good e-commerce expansion and sustainability initiatives. They are as of right now, they have already reached the goal of 40% sustainable cotton sourced, and they have more goals coming up. Stable dividend history, and that supports our valuation methods. So as of this was 2 days ago, their stock price of Carter's, if you see it 5 years, they are declining. But when we compared it to our to Carter's competitors, they actually second to best of their prices, and we see a lot of upside potential. Some overview and business model. Carter's was founded in 1865 in Atlanta, Georgia. Some of the key brands Carter's has is Oshkosh B'gosh, Little Planet, Skip Hop. There is a big distribution. They have over 1,000 stores in North America, with over 850 in the United States itself. This shows their generations who buy more their clothing. So over here in the market presence, this shows the 850 stores in the United States. This shows their channel, split of the channel. They have over 49.8% in retail, 35.9% in wholesale, and 14.3% international. And they are more and more expanding internationally. They have a forecast international estimated growth to go to more Asian and Latin Americas. They have 15% in India, 10% China, and 5% in the United States. We will talk more about why they are going to Asia and Latin America. Some competitive analysis in some industries. So the online baby industry is looking right now at $4.6 billion, with a forecasted growing at 2% compounded annual growth rate. Some of their key competitors are the Children's Place, Gap, and Amazon. Amazon private labels, because Carter's also sell through Amazon, so they have their own private labels. These are the market shares. We have Carter's is the biggest between other competitors, and this is other small competitors combined. Some of the cost structure that we have for Carter's, they spend a lot on COGS and SG&A. Financial analysis. So for revenue growth, it's expected to reach 10.2% CAGR by 2029. Their gross margin stability, it's stable over the years, showing that they have more, their gross margin is stable because of their ability to have their cash flow and the cost balance. ROE, it fluctuates between the years. It's because of the efficient capital use, and it fluctuates because of the shares buyback. Their balance sheet is very healthy, having a manageable debt to equity ratio. This helps them have a more stable dividend payout, and it's increasing over the years. The value. Some growth drivers that we see why Carter's will grow. Digital transformation. They are doing more e-commerce, which helps with more the new parents becoming, the new generation becoming parents and shopping more online than in person. Retail stores, they're having expanded partnerships with Amazon, Target, and Walmart. A sustainable trend. This is the trend to go eco-friendly right now, so they have a very good goal to go more sustainable using cotton and plastic, reducing plastic packaging and stuff like this. The geographic expansion, they are entering new markets outside of the US to help with their birth rate risk. The valuation summary, this is how we get our price. We average our models, DDM, PE ratio, PS, AV, EPI, TDA models, and we get our price target this way. And why we get the DDM model? This is what we used and how we used it. So the company should have very strong paying and increasing dividends. They have a 5.2 growth rate because of their dividend trends and industry forecasts. They maintain a healthy cash flow, supporting their dividend payments without excessive debt reliance. Reasonable required rate of return, the 9.5%, reflects a balanced risk premium given their low business volatility in the children's apparel sector. Some of the key risks and mitigation strategies. So I found out that they have the biggest risk right here is the declining birth rates and then raw material costs, supply chain disruptions. And going more and more in these details, they have the input cost as a risk They have more supply chain expenses right now. So how they are what is their strategy to mitigate this is by renegotiating their contracts and diversifying their sources from their suppliers. Their tariffs, they're also trying to get more U.S. manufacturing, localized manufacturing, or if they are going to do it outside of the U.S., they are looking in other markets like Vietnam, Bangladesh, and others, like Latin America. How they are mitigating some risk. Supplier diversification, investing in technology, and expanding product offerings to maintain their relevance. And then there's ESG and sustainability initiatives. So they already reached 40% sustainable cotton source used by 2023. In 2025, they have 50% of reducing plastic packaging. By 2027, they want to use 75% of renewable energy, and by 2030, they want to use 100% sustainable cotton. Their diversity and inclusion, there is over 36% of women in their leadership, which helps growing their supplier diversity. My final recommendation in conclusion. So Carter is a very strong buy. They have a very strong upside potential. They are a market leader in the US market share, and they're going internationally, expand their recognition and their brand loyalty. E-commerce and sustainability gives them long-term growth because going eco-friendly is the trend right now. And e-commerce helps with the new parents and new generations. Our valuation supports our buy recommendation and manageable risk with the strategic mitigation plans that they have right now will help them mitigate these risks and go over it. And I want to thank you all so much for the presentation. I want to thank CFA and Carter's and the judges. Thank you. And I'm happy to get the answers. The questions.
So a number of times, Sarah, you said we or our,
Yeah.
Did you do this work solo or did you have colleagues?
So we are a team of 4, but for the presentation I will work solely. So yeah, it was myself. But we did the report, so we get the numbers as a team, but the presentation itself, it was just me. So yeah.
Great. I'll start, Sarah. Thank you for your participation today.
Thank you.
You quoted a market share number, I think of 15%.
Yes.
Which seemed a little higher than some of the other numbers I've seen from my own research. What was the source for that?
So the source is using their 10Ks and the other competitors' 10K to see how much they have in the current retail and wholesale in the US, comparing this by the other competitors, and this is how we get the numbers.
Okay.
You were talking about that you expect revenue to grow for the next 5 years.
Yes.
However, their revenue over the last several years actually declined. So can you talk about why revenue declined over the past several years and why you think revenue will grow going forward? Okay.
So why their revenue is declining? So the revenue has been declining for the past couple of years because of after the COVID. So during COVID, it was very increasing birth rate in the U.S. and outside. So that was increasing, and then it got lower in the past 2 or 3 years because of after COVID, after the pandemic. And then it's going up because they're expanding more internationally, going to more higher birth rate countries like Asia and Latin America. They are also expanding their e-commerce. They expanding their e-commerce and looking more to sustainable sources and eco-friendly sources. So that will help them get more loyalty, and their customer will love them more to be stay with them for a lot more. Yep.
You had a slide with the dividend trend, and I think it was pretty consistently up to the right. There you go. But in 2020 with COVID, didn't they significantly cut the dividend that year?
They might cut. I don't have the information right at the top of my head, but if they did, what I'm thinking is if they did already cut the dividend in 2020, they rose it back up again. I was looking at their dividend payout, and it's increasing over the years. So they have a very strong history of paying the dividends and increasing it. So I think but I'm pretty sure in 2020 it was their strongest year. During COVID was their strongest year. Their stock price went to $101 during that time.
Yeah, I'm not sure about the stock price, but I think they did cut the dividend and their earnings went down. They had a rebound in 21.
Yeah.
But right now, with earnings estimates declining, the payout ratio is rising. And so, do you really think the company will continue to increase the dividend?
They might increase the dividends and continue to do that because they are expanding more and they are growing more as a company overall, so they will have more income and revenue coming in, so they will increase their dividends. Yes.
Can I look at your valuation summary slide, please? Okay, so you talked a little bit about your dividend discount model. Do you want to talk more about your other valuation models?
Sure. So PE and PH ratio was a comparison between Carter's and the other competitors, showing how their income and their sales, how it's going on. The EV and EPT TDA model was more about their current, what is it called? I don't have the word right at the top of my head. I have it in Arabic, not English. This is hard.
Who were the competitors that you use your comparables analysis?
It's the same competitors, the Children's Place, Gap, and Amazon private labels. It's the exact same competitors we have.
So how did you separate Amazon private labels from the rest of Amazon?
Amazon, I think they have a separate, in their 10K, they have a place for their separate labels for their children's apparel sector.
Mm-hmm.
Do you have any detail on the PE model? In other words, what PE and what E were you using to get 117? That sounds really strong.
I'm sorry, what do you mean, what?
Well, if earnings are, just to pick a round number, $5, you'd have to have a PE of over 20 in order to get a target price of 117.
Okay.
And I think the industry average PE is more like 12. So I don't understand why Carter's would command a premium PE on their earnings, which happen to be declining.
Okay. So what we use probably would be comparing the years, between the last 5 to 7 years of Carter's ratios, and this is probably the average of it. Yeah. So, yeah.
How do you think about the CEO leaving recently?
I I did not have that in mind, and I don't know the reasoning of why they are leaving, so I don't have an opinion about that.
What about the impact of the potential impact of tariffs on this company?
Okay, so what is going on right now, like because of the politicals having more higher tariffs on China right now specifically, they are mitigating this risk by either localizing their production in the US or using other countries like Vietnam or Bangladesh or Latin America to produce their products. So this is how they are doing it, or mitigating the risk.
Do you know if they, it's obviously a very competitive industry for online. Do you know if they offer free returns on their products?
I
No?
don't know information about that.
No problem.
What would you say are the major threats to their market share, their 15% market share?
So the major risk is the declining birth rate, right here. And how they are mitigating this is by expanding international markets, going to countries like Asia and like India or China, and going to Latin America as well. This will help with their declining birth rate in the US. And also the second one is raw materials cost. What they are doing right now is getting their raw materials from other places to help mitigate the cost, and they diversify their suppliers and they renegotiate their contracts to make sure their cost is still like reasonable.
Do you know if hostilities in the Red Sea have impacted their shipping over the last year or so?
So it's impacting right now. What is going on in the Red Sea, it's impacting right now. So what they are doing is they are sourcing different ways on how to get their shipping to stay on top of their like their brand of getting things at the same time, or everything at the same time to stay relevant. What they are doing is they're finding other ways to get through. To get their stuff shipped through. So, yeah.
In your valuation, what is your assumption for cost of capital? In your discount dividend model?
Cost of capital. Like what do you mean?
What do you assume for cost of equity? What do you assume for cost of debt?
Like the numbers themselves?
Mhm.
That's a good question. And I don't memorize the numbers.
How did your team get to that 9.5% required rate of return?
From their 10K. We did the risk premium, risk-free rate, and risk premium equations, and this is how we got it.
Last question.
Do you think their dividend is sustainable, given some of the recent trends, which have been negative?
Yeah, because they are growing in other ways outside of the U.S. market, so it's gonna stay sustainable. Yes.
Okay.
Thank you very much.